preparing for a Cash Management Analyst interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through what a cash management analyst does on a daily basis. A cash management analyst protects liquidity and makes sure the business can meet obligations on time. In practice, I monitor daily bank balances, forecast cash inflows and outflows, reconcile activity, support payments, and flag funding gaps early. The role also improves working capital visibility by coordinating with AP, AR, Treasury, and operations. Good cash management is not just reporting cash, it is turning cash data into timely funding and investment decisions. While answering, focus on liquidity ownership, daily balance monitoring, forecasting, payments, reconciliations, stakeholder coordination, and how the analyst turns bank data into operational funding decisions. Question 2. How would you prepare a daily cash position report? Daily cash positioning starts with confirmed opening bank balances. Then I layer in expected credits, outgoing payments, sweeps, debt service, payroll, and any restricted cash constraints. I compare the projected closing balance against minimum liquidity thresholds and facility requirements. If there is a shortfall, I recommend funding actions early. If there is excess cash, I identify whether it should be invested, swept, or left available for upcoming needs. Make sure to cover opening balances, expected inflows and outflows, minimum liquidity thresholds, bank cutoffs, restricted cash, and how you decide between funding, sweeping, or investing excess cash. Question 3. What inputs would you use to build a reliable cash forecast? I normally build cash forecasts from the bottom up, using AR collections, AP aging, payroll calendars, tax dates, debt schedules, CapEx plans, and historical seasonality. Short-term forecasts should be highly transactional, often daily or weekly, while longer-term forecasts can use drivers and assumptions. The key is variance tracking. After actuals come in, I compare forecast versus actual, identify misses, and refine assumptions so the forecast becomes more reliable. In your answer, talk about short-term versus long-term forecasting, AR and AP inputs, payroll, taxes, CapEx, seasonality, and the importance of variance analysis to improve forecast accuracy. Question 4. How would you investigate an unreconciled cash item in a bank reconciliation? Bank reconciliation confirms that the bank statement, ledger, and cash reports all tell the same story. I would match deposits, payments, fees, interest, transfers, and outstanding checks. Then investigate timing differences or errors. For an unreconciled item, I would trace it to source documents, contact accounts payable, accounts receivable, or the bank, and document the resolution. The priority is accuracy, clean audit support, and preventing a small mismatch from becoming a liquidity issue. Be sure to mention matching bank statements to the ledger, timing differences, outstanding checks, bank fees, deposits in transit, documentation, escalation, and why reconciliations support both liquidity and audit readiness. Question 5. What is liquidity risk, and how would you help manage it? Liquidity risk is the risk that the company cannot meet obligations when due, even if it is profitable on paper. I manage it through accurate forecasting, minimum cash thresholds, diversified bank relationships, committed credit facilities, and early escalation of large cash needs. I also watch concentration risk and covenant limits. A strong analyst does not wait for cash to run low. They create visibility before decisions become urgent. While answering, focus on the risk of not meeting obligations on time, minimum cash buffers, credit lines, bank diversification, covenants, forecasting discipline, and early escalation of potential shortfalls. Question 6. How do working capital movements affect a company's cash position? Working capital directly affects cash because revenue and profit do not equal immediate liquidity. If customers pay slower, inventory builds, or suppliers require faster payment, cash gets tied up. I would analyze DSO, DPO, inventory days, aging buckets, and collection trends to explain movements. For example, a profitable quarter can still create a cash squeeze if receivables rise sharply. That is why cash analysis has to connect accounting results with operating behavior. Make sure to connect working capital to cash flow, not just profitability. Include DSO, DPO, inventory days, aging reports, customer collections, supplier terms, and operational drivers behind cash movements. Question 7. If available cash is limited, how would you prioritize payments? If cash is tight, I would first identify non-negotiable payments: payroll, taxes, debt service, critical suppliers, and items tied to legal or operational risk. Then I would review payment terms, discounts, penalties, and vendor criticality. I would not make unilateral decisions. I would escalate options with clear cash impact and timing. The goal is to preserve operations, maintain trust, and avoid avoidable fees or covenant issues. In your answer, talk about payment criticality, payroll, taxes, debt service, key suppliers, penalties, discounts, communication with stakeholders, and why payment decisions require escalation rather than guesswork. Question 8. What controls are important in cash management and payment processing? Cash is high risk because it is liquid and easy to misdirect, so controls matter. I would expect segregation of duties between payment initiation, approval, release, and reconciliation, dual authorization for wires, vendor bank validation, positive pay, user access reviews, and exception reporting. As an analyst, I would follow procedures and challenge unusual activity. Strong controls protect the company without slowing routine payments unnecessarily or creating bottlenecks. Be sure to mention segregation of duties, dual approvals, positive pay, vendor bank validation, access controls, exception reporting, and how fraud prevention must balance control with efficient payment processing. Question 9. How should a company think about investing idle or excess cash? Excess cash should be managed according to the Treasury policy, not just chased for yield. I would consider liquidity needs, safety, maturity limits, counterparty risk, permitted instruments, and upcoming disbursements. For operating cash, capital preservation and same-day availability often matter more than return. If the forecast shows cash is truly surplus, I would recommend options such as money market funds, term deposits, or Treasury bills within policy limits. While answering, focus on Treasury policy, liquidity, capital preservation, maturity limits, counterparty risk, permitted instruments, yield trade-offs, and the difference between operating cash and truly surplus cash. Question 10. What would you do if actual cash flow is significantly different from the forecast? A forecast variance is useful only if I explain the cause and improve the next forecast. I would separate timing differences from true changes in cash flow. Then look at drivers such as delayed customer receipts, accelerated vendor payments, bank fees, FX movements, or missed transfers. I would quantify the variance, assign ownership, and update assumptions. Over time, this process builds credibility with Treasury leadership and operating teams. Make sure to cover timing versus permanent variances, root cause analysis, quantifying the impact, updating forecast assumptions, assigning ownership, and using variance trends to strengthen Treasury credibility. Question 11. How would you manage foreign currency cash balances or cross-border cash flows? Foreign currency cash creates both liquidity and translation risk. I would first identify balances and forecasted flows by currency, then assess whether cash is needed locally or can be converted, swept, or naturally offset. For material exposures, Treasury may use hedges under policy, but the analyst's job is clean visibility and timely data. I would also watch settlement dates, bank cutoffs, and trapped cash restrictions in certain jurisdictions. In your answer, talk about balances by currency, forecasted foreign flows, conversion timing, natural offsets, hedging policy, trapped cash, bank cutoffs, and settlement risk in cross-border cash management. Question 12. Can you explain cash pooling and why a company would use it? Cash pooling concentrates balances so the company can reduce idle cash, minimize borrowing, and improve liquidity control. In a physical sweep, funds move between accounts. In notional pooling, balances are offset for interest without necessarily transferring funds. I would mention legal, tax, banking, and intercompany considerations because pooling is not just operational. For a cash analyst, the key is accurate daily balances and clear visibility by entity. Be sure to explain physical sweeping versus notional pooling, why companies centralize balances, borrowing reduction, interest optimization, intercompany implications, legal constraints, and the analyst's role in daily visibility. Question 13. How would you use ERP or Treasury management systems in this role? I would use an ERP for accounting records and a Treasury management system for cash visibility, bank connectivity, forecasting, and payment workflows. The process should reduce manual spreadsheet risk, but I would still validate feeds, mapping, and approvals. If a bank file fails or a balance looks wrong, I would investigate quickly rather than blindly trust the system. Technology helps most when data governance and reconciliations are strong. While answering, focus on how ERP and TMS tools support bank connectivity, forecasting, payments, reporting, approvals, data integrity, system controls, and the need to validate automation outputs. Question 14. How would you review bank fees and identify opportunities to reduce costs? Bank fee analysis is about making sure we pay for services we use at rates we agreed with no unnecessary leakage. I would review account analysis statements, transaction volumes, wire fees, lockbox charges, balance credits, and service codes. I would compare fees to contracts and usage trends, then flag exceptions. This work supports cost control and also helps Treasury decide whether banking structures need simplification. Make sure to mention account analysis statements, transaction volumes, service codes, balance credits, contract rates, fee exceptions, rationalizing bank accounts, and how fee reviews support Treasury cost control. Question 15. A critical payment fails close to the bank cutoff time. What would you do? If a critical payment failed near cutoff, I would stay calm and verify the failure reason first. Bank connectivity, approval status, account funding, beneficiary details, sanction screening, or format issue. I would alert the right stakeholders, contact the bank, and determine whether an alternative payment method or same-day release is possible. After resolution, I would document the root cause and improve controls so the issue does not repeat. In your answer, talk about quickly diagnosing payment failures, bank cutoffs, approvals, formatting issues, beneficiary details, sanction screening, stakeholder communication, backup payment options, and post-incident root cause review. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.